Welcome to today's Explainer. Let's put on our economist hats and decode the confusing and, frankly, kind of crazy crosscurrents of the 2026 housing market. If you've been tracking real estate lately, you've probably noticed the headlines contradicting each other on a daily basis. Seriously, one day the market's crashing, the next day prices are hitting all-time highs. It's enough to give anyone whiplash. But today, we're cutting through all that noise. We're going to look strictly at the data to understand the exact mechanisms driving these trends, zooming all the way from global economic shifts right down to the inventory in your local neighborhood.
You know, to really get a grip on what's happening with local home prices, we've got to pan out and look at the broader macroeconomic picture. As an economist, I always say that local real estate is literally the final domino to fall in a very long chain of global economic events. You simply can't understand why a three-bedroom house in Austin or San Francisco is priced the way it is without first understanding bond yields, inflation metrics, and global supply chains. The underlying fundamentals are shifting rapidly beneath our feet, and today we're going to decode exactly what those signals are telling us.
So, here is our roadmap for today. We'll start with the macro inflation picture, funnel down into housing affordability, compare the Midwest and the South, analyze the West Coast divergence, look at the March 2027 rebound, and wrap up with a guide for first-time buyers.
All right, Section 1, the macro inflation picture.
Let's dive right into the forces driving the Federal Reserve's recent decisions because, at the end of the day, the cost of borrowing money is the gravity that dictates the entire housing market. The Fed has kept its target rate unchanged at a 3.5 to 3.75% range for a third consecutive meeting here in April 2026. Now, while that was widely expected, the internal dynamics are definitely shifting. Get this, the decision actually saw an 8-4 vote. That is the first time since October 1992 that 4 officials dissented against an FOMC decision. Some members are pushing for cuts, while others are pushing back on language suggesting they'll eventually resume cutting rates at all. They're trying to balance the risks, and a huge reason for this hesitation is just the sheer uncertainty around the broader economy.
And this perfectly illustrates what the Fed and the bond market are so worried about right now. Market watchers are totally bracing for the incoming April Consumer Price Index, or CPI, data. Consensus is calling for a 0.6% month-over-month headline rise. But more importantly, we're looking at an expected 0.3% rise in core CPI. Make no mistake, this April CPI data is the single biggest market catalyst right now because it directly shifts investor expectations for future rate cuts. If inflation stays hot, the Fed holds rates higher for longer, and that keeps mortgage rates elevated.
So, why is inflation threatening to run hot again? Well, as Pan and Asset Management points out, we have to look overseas at global geopolitics. Recently, President Trump rejected a peace proposal from Iran, which has led to a continuation of the impasse in the Middle East and kept the Strait of Hormuz effectively shut. And the market's reaction to this? Brent crude oil jumped 4.4% overnight, pushing right past $104 a barrel. From a purely economic standpoint, the longer these geopolitical energy shocks drag out, the more upward pressure we see on global oil prices. And that introduces a massive level of uncertainty into our domestic inflation forecasts.
This brings us to a crucial connection, the relationship between energy shocks and core inflation. If that April core CPI does break above 0.3%, it sends a massive signal to the market that these geopolitical energy price hikes are bleeding over into non-energy categories. It essentially means inflation is getting sticky again. When investors see this, poof, their expectations for Federal Reserve rate cuts just evaporate. Bond yields spike. In fact, we recently saw the 10-year Treasury yield take up to 4.9%, and that directly drives mortgage rate volatility. Because when the 10-year yield jumps, mortgage rates jump right alongside it, instantly changing the math for everyday homebuyers.
Moving on to Section 2, housing affordability and inventory.
Now let's look at how this exact mortgage rate volatility trickles down and hits the pavement in local neighborhoods. According to recent data from Codality, on a national level, year-over-year home price growth has slowed to a near standstill, sitting at just 0.4% as of March 2026. Now, it's worth noting that after a 7-month contraction, home values did actually tick up slightly by 0.3% from February to March. So we're absolutely not seeing a dramatic, catastrophic plunge in prices nationally. Instead, we're seeing a market that's just grinding its gears, caught between massive pent-up demand and a severe affordability crisis driven by those volatile mortgage rates we just talked about.
Dr. Selma Hepp really hit the nail on the head here. She says the housing market is currently stuck in a holding pattern. High mortgage rates have basically fenced off homeownership for a lot of average Americans. But here's the catch. Because broad discounting is so incredibly rare right now, prices are remaining stubbornly high. Sellers just aren't budging.
The data actually shows asking prices for newly listed homes are continuing to trend more than 2% above closing prices. So mortgage rate volatility is pricing buyers out, but it's also making sellers super reluctant to let go of their current low-rate mortgages, and that completely chokes off inventory.
Which brings us to Section 3, Midwest versus South markets.
Relying solely on that 0.4% national average is honestly a mistake because it totally masks a fascinating divergence happening just beneath the surface. When we compare recovery patterns, the Midwest and Northeast are actually leading the pack right now. States like Illinois and New Jersey are seeing really strong growth, with prices up over 5.5%. Why? Because their local inventory shortages are absolutely severe. For-sale inventories there remain 50% below pre-pandemic levels. This scarcity perfectly shows how local inventory shortages shape affordability. There just aren't enough homes, so prices climb. Contrast that with the pandemic-era darlings down south. We're seeing significant cooling in places like Florida, which is down 2.4% over the last year. And then look at Austin, Texas, which is just oscillating wildly. It plummeted 15% from its 2022 peak, but it's actually clawed back 2.5% since the start of 2026.
Now let's look out west. Section 4. West Coast Market Divergence.
Moving out to the Pacific, the market divergence is maybe the most striking and counterintuitive data point we have right now. If you just skim the headlines, you'd probably think the West Coast tech hubs are collapsing. And yeah, on paper, markets like Seattle and San Jose look like they were struggling with year-over-year declines after a 7-month contraction in late 2025. But look closer at the actual underlying fundamentals in the first quarter of 2026. San Francisco just experienced a surprising massive 5% price jump in the first 3 months of this year alone. Oakland is up nearly 2%. This is a stark contrast to that sluggish national trend of 0.4% growth. It tells us these high-cost tech centers are seeing localized surges totally decoupled from the rest of the country.
And because of those underlying fundamentals, specifically think about the massive wave of capital flowing into artificial intelligence and tech infrastructure right now, Quotality data officially classifies 7 specific markets, including San Francisco and San Jose, as undervalued. Now, when an economist says a market like San Francisco is undervalued, what they mean is that the current pricing correction went too deep relative to the region's actual long-term economic power. What we're likely witnessing right now is these West Coast cities aggressively bouncing off the absolute bottom of their correction cycle before they start systematically climbing again.
So where is this all heading? Section 5, the March 2027 rebound.
This brings us to a really critical projection for the future. Based on current trends, we're looking at a predicted market rebound by March 2027. The data points to this very specific horizon line. Right now, as we've established, the market is practically frozen. Activity is increasingly limited to cash buyers who can afford to just entirely ignore the Fed's interest rates. But there is a massive, unprecedented wave of persistent pent-up demand just sitting on the sidelines. Millennials and Gen Z buyers are waiting in the wings. If inflation cools over the next year, allowing the Fed to finally adjust policy and easing up that intense mortgage rate volatility, this dam is gonna break. The data suggests that by early 2027, all this sideline demand will break loose, ending the holding pattern and sparking a significant, broad-based rebound in market activity and price appreciation.
Let's make this actionable. Section 6, First-Time Buyer Guide.
So how do we translate all these macro and micro indicators into a strategy for you? Well, if you're a first-time buyer trying to break into this market, you have to think like an economist. Step 1. Monitor the core CPI data, specifically that April print we talked about. If it comes in hot, expect rates to stay high. If it cools, it's a signal for future rate relief. Step 2. Track your local inventory shortages like it's your job. National averages mean absolutely nothing if you're buying in the Midwest where inventory is down 50%. Inventory dictates seller leverage, which dictates your negotiating power. And step 3. Prepare financially right now for the anticipated 2027 activity rebound. If you wait until the Fed officially cuts rates to get your finances in order, you are going to be competing with millions of other buyers flooding back into the market all at the exact same time.
The underlying fundamentals of the 2026 property market are shifting right beneath our feet. The divergence between the rebounding West Coast, the booming Midwest, and the cooling South proves that there's no such thing as a single housing market. There are thousands of hyperlocal markets, and they are all tethered to global inflation and interest rates. With a broader rebound strongly projected for early 2027, the crucial question I leave you with is this. Are you going to use this data to adapt your strategy and make your next move, or are you going to remain stuck in the holding pattern? Thank you for joining me on this explainer. Keep your eyes on the data, and I'll see you next time.